You bought the index fund. You did everything right. You read the books. You watched the videos. You ignored the crypto guys. You ignored the stock pickers. You said, I'm going to be smart about this. I'm going to buy the whole market and just wait. So you waited. And now it's been 2 years, maybe 3, and your portfolio is down 11%, or flat, or up 4% when inflation ran at 7%. And somewhere in the back of your head, a voice keeps asking, was this actually the right call? That voice isn't stupidity. That's not impatience. That's what happens when no one told you the full story. Before you close this video, I know what you're thinking. You're thinking, this is one of those videos that's going to tell me index funds are bad and I should buy something else instead. Some guy's newsletter, some stock picks, some course. That's not what's happening here. Index funds are probably the best tool most people have access to. I believe that. The data supports that. But there's a version of the truth that the just buy an index crowd leaves out. And that gap between the theory and the lived experience, that's what this video is about. Here's what we're covering. First, what the real cost of index investing actually looks like in numbers most people never calculate. Second, the strongest argument in favor of passive investing, and exactly where that argument quietly breaks down. Third, the specific scenarios where a different approach is genuinely justified. Not for everyone, but maybe for you. And at the end, I'll give you a 3-question framework you can use today to figure out where you actually stand. Meet Anton. He's 31, software developer, makes $95,000 a year. Smart guy, read the right books. In 2019, Anton puts $12,000 into a total market index fund, sets up automatic contributions of $400 a month, does not touch it. By February 2020, he's got $17,400 in the account. Feeling good. March 2020. The account is at $11,200. He doesn't sell. He holds. That part he gets right. By end of 2021, the account is at $31,600. He's up. Significantly. He keeps contributing. Then 2022 hits. The account drops to $21,800. He's been investing for 3 years. He's net positive, but barely. And psychologically, he feels like he's been doing this for nothing. Here's the number Anton never calculated. From January 2019 to December 2022, Anton contributed a total of $31,200. His account is worth $21,800. He is sitting on a paper loss of $9,400 on money he actually put in. Now, on paper, this is normal. This is expected. Every index fund investor is told to expect this. But here's what nobody talks about. The opportunity cost of those 3 years wasn't just the money. It was the learning, the skill building, the compounding of knowledge that comes from being actively engaged with your own finances. Anton spent 3 years on autopilot. He didn't learn anything. He didn't develop any judgment. He just watched a number go up and down and told himself he was being patient. That's not investing. That's waiting. And waiting has a price. Here's the best argument for index funds, and I want to give it to you straight because it's genuinely strong. Active fund managers, professionals, with teams, with data, underperform the index 85% of the time over a 15-year period. That's not a talking point. That's from the SPIVA report, published annually. 85%. If the professionals can't beat it, why would you? That's the argument. And it's correct. Statistically, if you pick stocks, you will most likely do worse than the index. But here's what that argument quietly assumes. It assumes your goal is to replicate the index's return. It assumes you have a 15-year horizon with no liquidity events. It assumes your emotional behavior under pressure will be identical to a passive index, which has no emotions, never panic sells, never second guesses itself at 2 a.m. You are not an index fund. You have a job. You have rent. You have a family member who might need money. You have a brain that evolved to avoid loss, not to sit calmly through a 34% drawdown. The data on fund managers is real, but those fund managers are being measured on total return. They are not being measured on whether the investor stayed in the fund during the crash. They are not measuring the behavioral gap. The behavioral gap, the difference between the fund's return and the actual investor's return, averages 1.7% per year. Every year. Because people buy high, sell low, and panic at exactly the wrong moment. So yes, the index beats 85% of active managers. But the index only beats you if you actually hold it the way the backtest assumed you would. Most people don't. There are real situations where passive index investing is not the right primary strategy. I'm not going to pretend otherwise. If you have a short time horizon, less than 5 years, an index fund exposes you to drawdown risk you may not be able to recover from. If you need the money in 2028, you cannot afford to watch it drop 40% in 2027. If you are in the accumulation phase and have high income relative to your portfolio size, your monthly contributions matter more than your allocation. In that case, optimizing for behavior and consistency beats optimizing for the most efficient instrument. And if you have genuine sector knowledge, you work in biotech, you understand the regulatory landscape, you can read an FDA filing, then concentrating a portion of your portfolio in your area of expertise is not gambling. It's using an actual edge. The problem isn't index funds. The problem is that just buy the index became a lazy shortcut that people use instead of actually understanding what they own and why. Here's how the typical path actually goes. Not the backtest version, the real version. Year 1. You open the account. You feel good. You contribute every month. The market goes up slightly. You check it too often, but you're disciplined. You tell yourself, this is the long game. Year 2. There's a correction. 15% down in 6 weeks. You don't sell, but you stop contributing for 2 months because you're not sure. You tell yourself you'll restart when things stabilize. Things stabilize. You restart. You missed buying at the low. Year 3. The account is back up. You're roughly flat after 3 years of contributions. A colleague at work mentions he made 40% on a single position last year. You don't change anything, but the thought stays with you. Year 4. Another drawdown. This one feels different. The news is worse. You reduce your monthly contribution from $500 to $200 because you're being cautious. You tell yourself you'll increase it again soon. Year 5. You look at the account. You've contributed roughly $22,000 over 5 years. The account is worth $24,300. You've made $2,300 on $22,000 over 5 years. That's a 10.5% total return. Not annualized, total. No single decision destroyed the outcome. The contributions that stopped for 2 months, the reduced amounts during the scary quarters, the months you skipped entirely. Each one was reasonable in the moment. Together, they turned a historically strong instrument into a mediocre result. This is not a story about index funds failing. This is a story about the distance between the instrument and the human holding it. Here are 3 questions. Answer them honestly before you decide how you want to invest in the next 12 months. Most people think, do I believe in the long-term growth of the market? And the answer is yes, so they buy the index. The right question is, how will I behave during a 30% drawdown that lasts 18 months? Not how you want to behave, how you actually will. Because your behavior during that period will determine your real return, not the fund's listed return. Most people think, am I investing for the long term? And the answer is yes, so they feel safe. The right question is, do I have a liquidity event in the next 7 years that could force me to sell at the wrong time? A house, a career change, a health event, a child. If the answer is yes, your time horizon is not as long as you think it is. Most people think, am I diversified? And because they own a total market fund, the answer is yes. The right question is, do I understand what I own well enough to hold it when every headline says I should sell? Diversification without comprehension is not protection. It's just a more comfortable form of not knowing what you're doing. If you can answer all 3 of those questions clearly, you're ready. If you can't answer one of them, that's where you start. 3 things to hold on to. Index funds are not a passive strategy. They require active emotional management. That's the work. The behavioral gap is real. A 1.7% annual drag from bad timing decisions, compounded over 20 years, costs you more than any fund's expense ratio. The question is never just, what's the best instrument? The question is, what's the best instrument for how I actually behave under pressure? If this gave you something useful, share it with someone who's doing everything right and still doesn't understand why it doesn't feel right yet. That person exists in your contact list. This is exactly what they need to hear. Next video, I'm going to show you what a portfolio actually looks like when it's built around behavior first, not theory. Specific numbers, specific allocations, and the exact moment you should stop adding to an index and start doing something different. See you there.